Welcome back to the number one rated podcast in Kelowna, voted by Kelowna Now. We finally got our gold medal, Kelowna Real Estate Podcast.
Yes, we've done bronze, and then this year home run, gold medal. Love it.
Yeah. I mean, it's funny, right? Like the Kelowna Now voting, like you see a lot of social media, like people are always trying to get those votes and nominations.
Yeah.
And it kind of goes in like a couple, you do your nomination round and then the voting round. And it means a lot because it's kind of a pain to get through the voting. Like, you know, for somebody to vote for you, they actually have to do a bit of work. It's not just like click the button and they're done.
Yeah.
So yeah, sincerely appreciate everyone that gave us a vote.
Man.
Yeah.
Very awesome. Also, I feel like people in the podcast space, specifically like the media and like anyone that's public facing or like someone that's trying to have a presence, I feel like these awards kind of mean a bit more, you know, like they are tracking for something. So it means a lot.
Yeah. And I know like I'm not going for mortgage broker, you're not going for real estate agent. Like we don't really beat that drum for whatever reason. But you know what? We want to work together as a team on this podcast thing. And Nikki, our producer, has been like a huge reason why we've had so much success on it.
Yeah, definitely.
But yeah, it's awesome. So thank you to all the listeners and the guests. Like we've had some incredible guests on this year. So yeah, hopefully we can keep it going, man. Hey, Slogs, our hockey team, won gold. Now we're winning gold in this. What's next?
Man, we're on a roll. Gold comes in 3. Wonder what we're getting gold next.
Yeah. Anyways, thanks. Appreciate it, guys. We'll try and, you know, keep up the high standard of good content. With that, today we brought on one of our favorite returning guests. I think this is his 5th time on. Brendon Ogmundson, BCREA, Chief Economist. The guy is awesome, like super charismatic, but tons of data. Very analytical. Yeah. Not a lot of economists can like, you know, educate people the way he does and like actually make it enjoyable and like you're on the edge of your seat. So
hold an audience as an economist. I feel like that's not very popular, not a common thing. Yeah. It's got to be rare to be like that charismatic and also that sharp with the numbers. Like he's a great guest. That's why he's been on 5 times. We could honestly have him on every 2 months and never run out of anything to say.
I think we should just give him the show, honestly. You know, like let's tap out while we're on top and just let him roll with it.
That'll be our 3rd goal. Just give it to Brendon and be like, here you go.
Some of the takeaway I had, obviously, like everyone's asking the question, like, what are rates going to do? Are fixed rates going up, down? What's variable? Like, what's Bank of Canada thinking? Especially with, you know, the war in Iran. His track record is like unbelievably accurate when you look back at our previous shows.
Yeah.
He's been pretty spot on. So, you know, I don't want to like completely ruin it, but this show, he kind of highlighted, hey, we have seen the bond market price in for increases in the rates. We've already seen that on the fixed rate side, and we'll likely see some of that on the variable rate side or prime. You know, Bank of Canada is kind of having a hard time doing that, obviously, because our GDP is just suffering. Like our economy sucks right now. So how do you increase rates that's going to kill the economy? But their mandate is obviously controlling inflation. So, you know, he talked a lot about that. We kind of broke down a lot of other things. The one thing I would say on that, you know, choosing between like fixed and variable right now, I still like the static variable payment, which allows clients to have the cheaper rate. Currently, variable is a cheaper rate than 3 or 5 year fixed. But if rates change, your payment doesn't change. It just changes the amount going towards principal. So more or less would go towards principal and your amortization would lengthen or shorten. So I do think it's kind of one of the better products right now. I didn't like it kind of 2021 because rates were so low that we knew they would come up substantially. And when they did, you know, amortizations were going out to like 50 or 60 years, or we'd get to this trigger rate scenario where banks would be kind of calling clients and saying, we need to adjust your payment.
Yeah.
The other cool thing you could do, you could split it. Some lenders allow like a fixed and a variable. So you could do a mixed bag if you really want.
Yeah, it's kind of it's an interesting time in the market.
Okay. Well, thanks again, guys, for the vote and enjoy the show. All right, Brendon Ogmundson, thanks for coming back on the show. I think this is number 5.
Is it really?
4 or 5? Yeah. So you got to be our top returning guest for sure.
I think for sure. And it's awesome.
I've got that title with a few podcasts. Yeah. So happy to have and put another one in my belt.
Well, you're the rare breed that's extremely charismatic, but also knows all the numbers and information. Like those things don't usually
go
together.
It just means I have nothing better to do, and I will just say yes whenever anyone asks.
You would think as an economist, like we could speak to you monthly and there'd be new information. You would think as an economist, like it shouldn't change that often. but like it's been a crazy few years, hey?
Yeah, it's interesting. Like, so I try and have only two like presentation decks. Like, I'll do one for the first half of the year and one for the second. But I'm finding more and more I have to have like three and a half. Like, I gotta make a lot more changes than I think I would like to keep it fresh. But from the start of this year, there's been so much happening that it would have been impossible to forecast. I'm sure we'll get into interest rates and the Iran war and everything else and the impacts. But like, it's just a lot all the time.
Yeah. Well, speaking about forecasting, I listened to a bit of our show with you a year ago and you were bang on. So
was I?
A year ago, we were right in the thick of tariff announcement. I don't think everything was finalized yet, but we were discussing that and the impacts of it. And so we kind of said, hey, like crystal ball, how does that look? You said, well, prime should probably drop by 100 basis points and bring it down to like 4.2. So right now it's at 4.45. So very, very close. You said GDP would likely struggle. Inflation would probably come up a little bit and fixed rates will likely come up a little bit. So you got everything other than the war in Iran. Could you not predict that? Come on.
No, I know. Well, even like my forecast on sales, we were more optimistic, I think, for 2026 than things. Like, I thought we would have a better start to the year. Most markets have started out really slow. Some of it's just like, after this long, there's so much pent-up demand. Affordability is actually improved in a lot of places. You'd think that eventually we'd get some of that demand off the sidelines, but a lot of what I've been doing in my presentations is like, here are all of like the accumulation of shocks that have hit the market over the past few years. And like, it's just taken a long time kind of dig out from under all of those shocks.
Yeah. Well, can we maybe talk about like those transactions, that kind of data right now? Because for me, it has felt like a slower start this year. I know last year, beginning of 2025 was absolutely bumping, and then tariff announcement came out and it just like killed everything. And then it kind of, things normalized, I would say, kind of in the fall. But yeah, it definitely feels like a bit of a slower start to 2026.
Yeah, you can see it in the data for the Okanagan. Like the end of 2024, start of 2025 was really strong. Tariff stuff starts, all that uncertainty hit. Sales immediately fell to about 20% below the 10-year average, where they stayed. And then tried to mount a comeback through the summer of last year. Sales picked up and then ended the year pretty weak and started the year really weak. There's nothing to really point to, right? There's no real change like between the end of last year and the start of this year. Nothing to really like, oh, that's the obvious catalyst for why sales were so much weaker. They just were. I've got a whole bunch of theories about vibes that we can talk about, but like there's like macro factors and you're going to exhaust the list of things. Like prices are flat to slightly down. Like at the time, at least before the Iran war stuff this year, rates had actually been coming down. The 5-year yield had fallen as low as 2.6. We were about to get, fixed mortgage rate that was like close to 4%. And then events transpired for that not to be the case. But if you just looked at macro factors, there wasn't a lot to point to for why we had started such a weak year. Maybe looking back now, like I put a chart up on LinkedIn yesterday or the day before, tracing private sector employment this year. Well, since the peak when private sector employment peaked in 2025, in September 2025, versus past recessions. So I've got this like kind of growing concern that the BC economy might be tipping into a recession, not Canada, but the province. Private sector employment, since it peaked, is at its weakest level, or is on its worst path, I guess you could say, since the 1981 recession, not counting COVID, which was a very sharp drop.
Yeah.
But we've lost 60,000 private sector jobs this year. That's pretty startling. That puts us on par, like in terms of like percentage loss with like 1981 or like the financial crisis. It's really bad.
Is public sector jobs increasing?
Slightly. Just very, very slightly. Their plan is to decrease payrolls through like attrition, but not really seeing it much lately. Some of that public-private sector stuff gets a little bit muddy too, because like teachers, doctors, nurses are public sector. So like I prefer to look at, if I'm thinking just like pure government bloat, there is a category in like the industry, category is called public administration. And that's like pure like bureaucracy. Yeah. That's where we've seen like just a ton of growth without, I would think most people would argue, any improvement in like government services. Just a lot more people. Obviously, we need teachers. We need more people working in healthcare. Obviously, we're going to keep adding people in healthcare. Hopefully, more frontline healthcare than like middle management, health authority kind of jobs. But like, frontline healthcare workers, certainly we need way more of those as population ages and everything else. Things you guys know about the Okanagan, given your demographics.
Yeah, we're struggling with the services here for sure. Do you know then geographically, like for private sector, I'm just assuming like Kelowna, is it predominantly like, is that where we're seeing our job loss? Because we are seeing like a fairly large increase in unemployment.
Yeah, I don't know. The data at like the CMA level, so like Kelowna, like the big city kind of level, is pretty noisy. So I don't really, it's usually smooth by 3 months. And I don't trust it that much. It's just really noisy. So it's hard to say geographically. We try and track, like we have our nowcast where we track economic growth in the province. Then we have these regional ones. Hard to benchmark those because there's no like real GDP number for the Okanagan, but we try and track growth. And the Okanagan's been a little bit more resilient than like the rest of the province. It's actually growing a little bit faster. Some of that's demographics too. Like the Okanagan's kind of odd in that it has kind of this bimodal kind of age cohorts. We have a lot of retirees, but also like a lot of young people. Like when I was in Kelowna last week, like everywhere you look, it's just like very young, very fit people. You guys are a fit culture. It's like, wow, everyone here is in great shape. And then there's also like, you've got like the older demographics who are, I don't know, golfing and do whatever they do. But yeah, it's a really interesting area for that. And that has like unique consequences for housing too. Because you've got a lot of young people that probably would like housing, a lot of older retirees coming in with, their large savings, and that puts like weird pressure on the housing stock. So it's an interesting dilemma, I think, in that market.
Yeah, there's a huge wedge between, it seems like a surplus of condos that have been coming online to, like people want that larger single family home, but there's kind of nothing in between, like the townhouse market. There's some room for growth there, but the cost.
Missing middle. Like it's so weird. Like in markets like Kelowna, which is, a growing city in BC, you'd think that we wouldn't keep repeating the exact same mistakes. Like there is a template not to follow that like the Lower Mainland has, where it's like, oh, let's not build any missing middle housing. Let's just have like single family homes that are too large or very, very small condos and nothing in between.
Yeah.
I don't know why cities keep doing this as they grow. Like they don't realize, hey, maybe we should have like some quasi affordable multi-bedroom kind of product. Maybe it doesn't make sense to build. I don't know what it is, but it always gets overlooked.
I know. It's like, do they even build 3-bedroom, 2-bathroom houses that are 2,000, 2,500 square feet anymore? Like, they just don't exist.
You think, right? Like, I remember one of my first places we lived in was like an 1,800 square foot, I think 3-bedroom townhouse. It was perfect. It had a little bit of a backyard. I don't understand why there's not more of that. And it was on 2 levels. It wasn't like those like really skinny, like 3-level townhouses. It was the perfect size and perfect layout. And they just don't really do that.
Yeah. Especially from the mortgage side, like most applications come in and you're like, yeah, you're approved for that between like 800 and 900,000. And they're like, right, I can't find a home for that, but I can find a condo at 700. I don't want a condo.
Right.
I want a home for $1 million, but I can't, like, it's just this weird void there.
I know. That's why it's called the missing middle, because it's missing. Right.
Yeah. I get this question all the time right now, always have historically. Obviously people look for this. Since you did such a good job predicting last time, maybe we can bring out your crystal ball again. Variable, fixed rates, people are deciding which direction to go. Obviously, there's a lot of caveats to that. What kind of amortization, if it's insured, not rental, whatever. But I guess where are we thinking in the next 6 to 12 months, prime is going, and where are we thinking the bond market fixed rates are going?
Yeah. So I'll start at the beginning of the year and what I was thinking, and then they'll kind of inform how I think the rest of the year is going to go. So start of the year, we were seeing inflation come down a little faster than expected. So I like to watch core inflation, but more specifically, the 3-month annualized rate of core inflation, because it gives you a sense of like, what's the underlying momentum? So if it's slower than like the 12-month, you can expect that inflation is going to start to come down. And what we were seeing in those 3-month core measures was inflation running at like 1%. Like really decelerating. Like 12-month core was still kind of around, between 2 and 3, but like it was slowing down fast. And now that's why you have core inflation on a 12-month basis back to about 2% as of was last reading April. So with inflation that's coming down, we have a job market that's pretty weak. So not just in BC where we've lost, in total have lost jobs in 4 of the past 5 months, but 60,000 private sector jobs. Across Canada, we've lost 80,000 jobs in February alone, over 100,000 jobs this year. So a really weak labor market, inflation that was decelerating. So in my mind, that was a Bank of Canada that would, at the very least, be leaving rates unchanged. and maybe would have to start thinking about lowering rates below, like they're at the bottom end where they think is neutral for the economy right now at 2.25. Maybe they'd have to go to 2 or 1.75. Then, of course, the United States starts dropping bombs on Iran and the Strait of Hormuz closes, and we have oil prices spike above $110. When we fed through like what the oil futures curve looked like after those events into our models, tells us, well, inflation's probably going to spike to above 3%. It was 2.8 most recent reading, headline inflation. The impacts on GDP, so we're an oil exporting country, but this is a supply shock. So all it really does is increase prices. There's no new demand. So this isn't something where oil companies see like, oh, prices are rising, there's so much demand, let's invest more, let's hire more. It's really just a windfall for producers. And more those producers are located outside of Canada. Like the owners are outside of Canada, so we don't necessarily get all the profits. So there's a mild positive impact to growth, but that gets overwhelmed pretty quickly by the effect of everyone on this call going to the gas pump and it's $2.30 a liter where I am. And when I was in Kelowna, I think it was over $2. So
yeah.
That hurts consumption, and those effects start to outweigh. So you get this sort of stagflationary effect where growth is a little bit lower than would be otherwise and inflation's a lot higher. The real question then is, what does the Bank of Canada do in that scenario? In a model, it's very simple. There's a real bias towards fighting inflation in all macro models. So our little computer version of Tiff Macklem raises rates back to 2.75 in the model to quell inflation, which eventually comes down. In reality, I think it's a lot more nuanced. There was a deputy governor of the Bank of Canada, Sharon Kozicki, brilliant economist, unfortunately retiring, so they're losing one of their best people. But she had this great speech right before all this kicked off about how central banks should respond to supply shocks like this. And it's really kind of a simple, intuitive framework. If it's a really big shock that's really persistent, then they probably have to act more aggressively. And if it's a small shock, they can probably look past it. This, unfortunately, is a really, really big shock. It's 20% of oil production that goes through the Strait. By most measures, this is the largest oil supply shock since the 70s. And then the other question then is it persistent? Is this going to last a long time?
Yes.
Can the Bank of Canada look through this? Doesn't seem to be ending anytime soon. From like oil experts I've read and listened to, like this is a pretty pivotal month for oil inventories. I guess a lot of production has been coming out of inventories, but those inventories are depleting rapidly. So we could see oil prices really jump if we don't get some resolution soon. Prices have been basically held in check by just using inventories. So the inflationary effects and like the lingering impacts, like the longer this goes, if you own a trucking company and your costs are going up a lot when you bring, produce to a grocery store or whatever, you could probably, eat those costs for a month or two and not pass them on to stores, but you can only do that for so long. And eventually those prices are get passed on. Then they get passed on, from a grocery store and consumer prices. Then you get this sort of spiral where oil prices start driving all consumer prices higher. And then people see prices at the grocery store and the gas pump and everywhere else rising. They ask their employer, like, I need a bigger wage increase this year. You just get this really difficult spiral that then the bank has to be really aggressive to try and break. And we saw this. This is exactly what happened during COVID. And so the question of the Bank of Canada is they were pretty roundly criticized for acting too late during COVID. They waited about a year to start raising rates when inflation was very clearly rising. That's pretty fresh in their minds. Maybe they want to get some credibility back by being more aggressive this time around and raising rates in the United States, which is also super important for what happens to bond yields here. The Fed has gone from an assumption by markets that they were going to be cutting rates once Kevin Warsh came in, he was sworn in today, to now expecting that they might actually have to raise rates. So all of that means like even if the Bank of Canada isn't going to raise rates this year, even if they keep rates level, we've seen 5-year bond yields jump significantly. I mean, they touched like 3.4 this week, come down since, but because of expectations that central bankers in both the US and Canada might have to raise rates to fight this inflation. So a lot of what's in the 5-year bond yield right now is pure expectations about monetary policies. Like you can kind of look at any bond yield and break it into two parts. One is, what do markets expect, the central bank's going to do? And the other part is like a risk premium. And so part of what we've seen is higher risk. And that's about, I think, 20, 30 basis points if you look at the Bank of Canada's data. And a big part of it, though, is just expectations that banks have to raise rates. So super long-winded answer to your question, and it's like essentially I don't know. I don't think the Bank of Canada will raise rates because the labor market is really weak and the economy is a little bit weaker than I think GDP growth is suggesting. But it kind of doesn't matter, right? Because 5-year fixed rates are already rising significantly just because of expectations. This whole choice between a variable and a fixed, then fixed rates could come down if this gets settled tomorrow and all that expectations for rising rates gets pulled out of bond yields and we're back to where we were pre-war. But if you take a variable rate, you're also risking that markets are right and the Bank of Canada is going to raise rates at least twice this year. So that's why a lot of people are taking a 3-year lately, because like it's still a pretty decent rate and you can kind of bypass all this uncertainty.
Yeah, I mean, we've been doing 3 years for like 5 years now. It just seems like the best product for the most part. So something you said at the beginning there, so it seems like inflation kind of supersedes GDP in terms of like what Bank of Canada is focusing on, because they're in such a difficult position, right? It's like the economy sucks, so you have to lower the rates. But if inflation, starts to run away again, like it doesn't matter what our economy is doing, like inflation's just going to level anyone. Yeah,
ultimately, their mandate is to keep inflation at 2% over the medium term. That's their reason to exist. So they're always going to have a bias towards controlling inflation.
Yeah.
Is there any hope that Alberta gets a boom and that money comes to us, like even in the long run?
That's like, the only region that might benefit from this, right? I guess maybe BC because of LNG, if LNG prices also rise. Yeah. But even then, like those are mostly foreign-owned companies, I think. So again, it's really just kind of a profit windfall. And the Bank of Canada released a really good study, I think it was the Bank of Canada, not too long ago, about the change in ownership in oil companies in Canada, like how much more of it's consolidated in the United States than in Canada. So we don't necessarily get like the positive benefits of like those windfall profits.
Perfect. So if the Strait of Hormuz is just closed indefinitely, which it honestly kind of hard to see how it opens anytime soon, there won't be a pressure on Alberta or Canada to start producing more oil to fill that void? Because right now we're just using reserves, right? We're using strategic reserves to kind of level us out.
I guess like if you could, but again, like this isn't demand driven. So if you say you're a large oil company, you're planning for the future, are you going to invest a whole bunch in hiring and new trucks and everything else for something that's a temporary shock to home prices?
Yeah,
to the oil prices, away. Right? Like then what? Then this gets settled, the oil prices come back down, there's not any new demand, and now you have all this kind of surplus that you've invested in. You gotta So that's why like a supply shock is a lot different than if this was being driven by global economy was on fire and everything was growing really fast, and that was driving more and more demand for petrochemical products. But like that's not what this is. This is just a pure supply shock and higher prices.
In terms of price at the pump, can you tell me if I'm crazy here? Because like I understand the volatility, obviously with war, ceasefire, Trump's tweeting, but like I feel on a Thursday, it's $2 a liter. 2 days later, it's $1.60. 2 days later, it's $2. Like there's like 40-cent swings every 3 days. Why?
Yeah, I don't know. I mean, I'm not super dialed in on the economics of individual gas stations, but like I remember reading there's a really good paper. It takes like, I can't remember what it is, like 6 weeks or something for the price of oil to transmit to the price of the pump or something. And then there's like refineries, sometimes refineries are down, and like there's so many different factors. I remember trying to explain this to like in-laws and stuff at some point, but it's always just like, it's easier to be like, oh, they're all just colluding. They're all like, that's always like, everyone always has their pet theory about gas stations, and like no amount of like economics is ever convince them otherwise. So yeah. Believe what you want to believe. You're going to be paying it regardless of what your own theory is.
Yeah. And then in terms of kind of, does this obviously affect cost of housing with inflation? Yes. But like, where does it go for like supply and demand of housing? Like, where are we at now with obviously, a year ago, 2 years ago when we had you on previously, it was like, we need a substantial amount of units to drive, housing to that affordability marker, whether that's, the war or not including the war. Like, how are we looking in terms of housing now for our forecast?
Yeah. So one more shock, right? Like when you think about the accumulated effects, like first we had inflation and then massive, rapidly rising interest rates. Then we had uncertainty and tariff shocks. Now we have this Iran war shock that is driving mortgage rates higher. So it obviously hurts demand in the short run at a time when demand is already very, very weak. So this is just one more thing that might kind of stifle a recovery this year. So it's mostly on the demand side. Well, on the supply side just means we get, higher levels of active listings if things stay on the market longer. When we look at like resale listings in the Okanagan, most of the rest of the province, nothing too alarming. Like we're up a lot, but we're up from like, look at the past decade, we had like crisis low levels of inventory that led to prices spiraling much, much higher. So where we're at with inventory right now is actually kind of where I would like inventory to be all the time to keep markets in balance. So I'm not super concerned on the inventory side. I'm more like we need demand to pick up and then, make sure that we're resupplying the housing market enough. And that's where my biggest concern is that we're setting ourselves up for 2-3 years from now, demand is kind of back to normal. And because of all of the like regulatory policy, taxes, everything else that we're doing to kind of stifle development, we're not going to have enough supply. And we're going to get this sort of reigniting prices again. A lot of what's going on right now is there's just so much unsold inventory. Not so much in Kelowna, but in the province, we were at the highest level since like 1995. And we wrote a report about it, kind of the risk of like replaying the 2010s. Were either of you in the market like post-financial crisis?
I bought my first place in 2008, literally the worst time you could buy.
Good time.
I bought my first place in 2012.
Okay, better timing. So you recall like this is a real thing in the Okanagan, like building was going crazy in Kelowna right before the financial crisis, and then demand fell out, and there was an overhang of inventory that lasted a really long time and kept prices flat till like 2014 or so. And then demand started to come back for a number of different reasons, and prices shot up. In Kelowna, I think from 2015 to 2019, prices went up like 50% or something.
Yeah.
So I'm really worried about that happening again. We have all this inventory, especially in the lower mainland. There's about 6,000 units completed and unsold, which means two things. Developers aren't going to build if they can't sell what they've already completed. That means much slower housing starts down the road. Yeah, that means like there's this sort of air pocket open up for when demand comes back and then prices really accelerate. Kelowna is really interesting in that inventory spiked at the end of 2025. It was at the highest level since the 90s.
Yeah.
And then immediately came back down in like February. And I think I heard some people say the units that were for sale that were supposed to be short-term rental. And then once the vacancy rate was high enough that Kelowna could opt out of the short-term rental restrictions, that they just all got pulled. Now it can be short-term rental again. That would explain the weird spike and then fall in inventory. I don't think anyone came and bought 300 or 400 units of condos in Kelowna in 2 months. So maybe that's what's going on. It's kind of strange. Or it's just weirdness in CMHC's data.
Yeah. I feel like we have been, and I say we, like Matt and I have been beating this drum for the last couple of years of like, this is kind of the low in the market. Like there is an opportunity here to maybe buy. And like in a few years, like it's got to pick up because there is that supply and demand, like just to go back to basics. But I also now feel like I'm starting to get like a little repetitive. I guess if you had cash to deploy, are you looking to buy as an investment in real estate? Like take away, policy and volatility of like, restrictions on that.
If I was, it would certainly be in either the Fraser Valley or the Okanagan, simply because those are the markets that have been kind of the most beat up over the last 3 years or so. So like there's a lot of pent up demand. Sales are just way below their 10-year average, and those sales tend to revert back to average. And the Okanagan, it's like 30% of the population in the Okanagan is between 25 and 44. In the Fraser Valley, it's like 32%, maybe not 44, so maybe not young. No shade at you guys. I'm almost 47. I'm definitely not young.
I just turned 40.
That is the age group where you tend to have either first-time home buyers or move-up buyers, right? There's a lot of buying activity that happens in that exact age cohort.
Yeah.
And there's a lot of those people in the Okanagan and the Fraser Valley. Fraser Valley's got some other kind of benefits, like Surrey's growing even faster than Kelowna. It's going to get rapid transit in the next 5 years. They're really bad at supplying the market with housing. They only build about 4,000 units of housing a year.
Yeah.
So like those are the markets where I would expect when things come back, they're going to come back in a big way.
I guess the difference in this market is we also had, because of the CMHC financing, building the purpose-built rentals, we've had like a glut in rentals. Like you can say that the values of the properties are like at the bottom, probably going up from here, but they're still not even close to cash flowing because of the rental.
Yeah, you're kind of buying for appreciation instead of...
Yeah, so like how many people can just buy a $700,000 condo and wait for it to appreciate with negative cash flow. So it's a tough ask for buyers, right? So I think
that's a big part of what's going on the demand side too, is we've effectively chased away investors, right? There's just so many things that you can't do with your own property at this point without incurring some kind of penalty. Plus, on top of that, at least this is temporary. On the demand side, we have a federal immigration policy that is essentially sending renters out of the country. The federal government between 2025 and 26 wants to dramatically lower the share of non-permanent residents, international students and temporary foreign workers mostly, by like 900,000 people over 2 years. In BC last year, we saw a reduction of 80,000 people, non-permanent residents. So which led to our first contraction in our population, I think, since Confederation, Canadian level and in BC as well. So really abnormal to have negative population growth in Canada, and 99% of non-permanent residents are renters. So we sent essentially 80,000 renters, because they're usually like, students and temporary foreign workers are usually like one-person households. So we sent like 80,000 renters out of the country at the same time as we're completing more purpose-built rental than any time in decades.
That's an interesting
No
take.
shock that Kelowna's vacancy rate is like 6% and going higher.
Matt, so is there going to be like in the short to medium term, do you expect that to change?
So 2025 and 26 is the massive outflows. And then they're going to allow like a trickle of positive inflow of non-permanent residents in 2027. And it gets back to like normal in 2028. So we'll kind of stop, hitting ourselves in the head in 2026 essentially. But it's going to take a while for population growth to recover. But then again, when it does, all of a sudden we have one more thing normalizing demand, and maybe it'll be well supplied on the rental side of things. But you got to think like we're building so much purpose-built rental. What does this mean for the housing market like 10 years from now? Do we have a scarcity of ownership product? Do a lot of those purpose-built rentals get converted to strata at some point? Like we saw that, I think, in the 90s. I can't see us having this much rental long term. We built so much, and CMHC is financed like 85% of it.
It's the only way to make it pencil.
We actually had a developer do the opposite, where it was built for stratification to sell, and then they converted it. And this was recent to purpose-built rental.
Yeah, that's happening a lot. If you've got a development that's well underway and they can't hit their pre-sale marks, like we've seen a lot of those then pivot towards purpose-built rental because they can get all the incentive financing and 50-year amortizations and everything else.
Okay, Brendon, I have to ask you, totally change gears. So how has the Cowichan ruling affected us? And is it just vibes, or is it having a material effect here?
Only speak on like the economic side. Like, there's no sign in the data that it's had any kind of impact. The one place where it could be making a difference, and even then, hard to say, is just like uncertainty, right? That's just one more piece of uncertainty. And even then, like, I don't know how strong the data is, even if you looked at this different issue, but like the DRIPA stuff and its effect on business investment. The BC Business Council surveyed, I think, their members who, there might be some bias in their sample, but like 75% of people in that survey said they were going to hold back on investing in hiring because of the uncertainty caused by DRIPA. So way out of my kind of normal jurisdiction, but like in the one way it might be affecting things, like the bedrock of capitalism is certainty about property rights. Anything that clouds that certainty even a little bit is probably not helpful.
So I agree with you. And on this podcast and just in my day-to-day life, it feels like everybody is saying like, oh, this capital's pulled out, these people aren't investing. Like, it just seems anecdotal to me. And I saw you posting lately about vibes, and I was like, man, this is a vibe issue. So,
it might be. So I love talking about this issue. It's funny because like I'm a pretty quantitative person, and vibe sounds like more kind of squishy and about feelings, but I've made it. I've made feelings in the numbers.
Your wife must love that.
Yeah. So like there's a few things going on. Like probably the most popular chart I've made maybe ever that I put on LinkedIn and I show it in speaking engagements is this chart that I've called "Why is everyone so mad all the time?" in one chart. And it compares wage growth since 2021 with shelter prices, so rent or ownership housing, and food. And so wages have gone up 20% since 2021, but food and shelter have gone up 30%. So you've got, all of your clients will be dealing with this all the time, right? Like you're talking to them about buying a house or whatever, and every time they go to the grocery store, everything's more expensive. Now every time they go to the gas station, it's more expensive. Maybe their rent is increasing. Their paycheck's growing, but they're not getting ahead on like basic items. And I think that's like the underlying economic anxiety for a lot of this. It's just the price level went up a lot. Even though inflation's back under control, things are still really expensive. That just kind of weighs on people. So there's that. And then I was looking for something besides, like, I probably talked about the economic policy uncertainty index. Any economist in the past 2 years have just shown that chart 8 million times with uncertainty flying off the axes. But it just doesn't explain that much. So it's like, well, what else is going on? So I found a bunch of data. The Bank of Canada does a survey of consumer expectations. So they ask people things like, what's the probability you're going to lose your job in the next 12 months? And that's at like 20% right now. The only time it's ever been higher was during the first quarter of last year during the tariff uncertainty. But it's still almost at that same level. So right now, a fifth of Canadians think there's a 20% chance they might lose their job this year. You don't go and buy a house, right? And who knows what that is? Maybe that's still tariff uncertainty. Maybe it's AI. Who knows what that is? But it's a real thing. And then also in that survey is like asking about how they would rate their financial health, what are their plans, kind of consumer spending over the next year, how do they rate the labor market. So basically I took the policy uncertainty index and a bunch of that Bank of Canada survey data, and I performed like a statistical procedure on it to extract a trend. And I just call that vibes because I'm not a very serious person. But it does correlate really well with home sales. It explains about 25% of home sales over the past 10 years. And it fall like vibes got real bad at the same time that home sales really, really fell off. So maybe there's something to that, but it is based in like, how are people feeling? And they're not feeling great about the prospects for the economy or their own kind of financial situation. It's funny if you compare it. There's this Arthur Okun, who's a really famous economist from I think the 60s, coined this really elegant kind of definition of misery index. Misery equals inflation plus the unemployment rate. So like if you don't have a job and prices are rising, it's a pretty good recipe for misery. Our vibes index correlates really well with the misery index, except for like 2024. So whatever we're getting in vibes is not necessarily just the economy, or not that kind of summary of the economy. There's something else going on. Is it the overall price level? Is it housing affordability? Is it Trump? It's something that's not in the economic data currently is affecting people. And I'm sure you guys see this all the time, talking to clients. Like, there's not feeling great about the state of the economy, the state of the world. Who knows?
Yeah. The trend of that kind of diversion seems to just be continuing, right? Like everyone's like, oh, yeah, 50 years ago when my parents bought their first place, the income was this and the purchase price was this. Like, yeah, it was easy. And now we're just continuing that trend. So like in 50 years from now, we're going to be like, oh yeah, it was easy. My parents bought their first house for $1 million and made $100,000. And now the house is $10 million. Like, what is the solution? Like, does it just go like this indefinitely?
There is something to that too, where like every generation thinks that they've had it the worst. It's funny, like one of my other decks, a chart of mortgage rates for every generation, going back to like silent generation or whatever. So like, what was the mortgage rate during their peak home buying years? And I just have this joke that like, if you mention mortgage rates to anyone over 60, they're almost like legally obligated to tell you that their first mortgage rate was 20%.
Yeah.
Like it's immediate. Like
yeah.
And so, but it's true. Like if you had a mortgage of 20%, wouldn't you tell everyone that ever brought it up? Because it is kind of startling that it was ever that high.
Yeah, it's like a feather in their cap. Like I was able to pay that.
Look what I went through.
Congratulations.
I fought in the mortgage wars of the early 1980s. But yeah, like this generation does have it kind of tough because like it's the first generation to really have mortgage rates that have been rising. Like obviously they're volatile, but like this is the first generation. Like if you're a Gen, whatever it is, if you're a millennial or Gen Z, like mortgage rates have actually gone up over the past couple of years. And not only that, you have to qualify with the stress test, which didn't impact people in the 2000s and the 90s. Like it's more difficult to qualify. And then graduating into this job market, it's one of the worst job markets I've seen. The employment rate for people aged 20 to 24 is at its lowest levels, like, I don't know, ever? BC, anyway. It's really low.
Yeah.
So you could make an argument, I guess, for like this current generation, like if you're in your 20s, and also like I give this example all the time, the effect of AI. Imagine if you're a high school student who worked super hard, all through high school, incredible grades, maybe got into like Waterloo computer science or something.
Yeah.
You're in your third year, you're thinking like, oh, when I graduate, my choice of $200,000 a year software engineering job, and now those are gone.
I'm the top coder in my class. It's like,
right.
No.
And like, what do you do? Like, what do you do?
Yeah.
It's a really, really difficult time for young people.
Yeah.
I don't have any answers for them.
The computer one is like kind of just the tip of the iceberg. Like it's going to be like anyone, right, coming up.
Yeah.
So it's like that are the first ones that are the obvious ones, but like even like lawyers, I feel like.
If AI learns to podcast, I don't know, you guys.
Yeah, we're out of a very unprofitable.
I'm sure it's a very lucrative sideline.
Yeah, we're definitely making money here.
AI takes over our podcast. Taylor and I are actually going to make more money, which is actually funny.
Sure, right?
Yeah, absolutely.
Your productivity will skyrocket.
Yeah, exactly. Yeah.
Before we let you go, can I ask a couple questions from a friend? Let's say this friend, like we were talking about the condo market in Kelowna, bought a couple condos in the previous, 3 years. So kind of in the peak for condo prices. And now you're looking at these prices like, wow, like even as a broker, I'm now getting appraisals back that are like, the purchase price was $670 and now the appraisal's at $500. And you're like, wow, someone should like dollar cost average. If you made a couple purchases, 3-4 years ago, you could argue that these are some pretty low prices, like to kind of level out that portfolio. Maybe now's a good time to buy. Or would you say, you know what, that asset class is still saturated for the next few years. It's not going to cash flow. I would kind of lean to like buying some affordable-ish single family homes because, if we're talking about, I think you said like 20 to 45-year-olds, like first-time home buyer, is that an asset class that is obviously builders aren't building, the cost to build is too expensive, the land acquisition, what would you advise this friend do?
That's a great question. Because like as an investment too, like I'm not super bullish on price appreciation, except there is that risk that we're in this air pocket and we find ourselves undersupplied 2028, 29. Maybe not in Kelowna so much as in like the lower mainland, but still, like you guys do have those population pressures too. If it was just like in the next 3 years, I don't think you're gonna get very much at all on price appreciation rents because of immigration policy and how much purpose-built rental is being built are also going to be kind of suppressed. So it's not a great return. So you're really like banking on basically like the total failure of our ability to supply the market over the next decade, which is probably a pretty safe bet.
Yeah.
Right? Because that's what we've done for the previous 30 years on the ownership side. And so like, how long is your window? Like you might have 5 years where you might as well just put in a term deposit versus, the hassle, especially of being a landlord, which is also no picnic in BC. And this is why we're seeing so much capital go into Alberta markets because still relatively affordable to get in. There's still room for price appreciation and the rents aren't falling as much. So like I think the returns in those markets are much higher than most markets in BC. So I think for investors, just because of the way policies lined up against it, investors and what's going on the supply and demand side of rental, that's going to be a really tough market segment for 2 to 3 years. But you're kind of banking on, if you're going to hold it for a really long time, either you're going to be able to use them as short-term rental and then maybe their cash flow is better, or you're going to get higher than sort of like a risk-free rate returns after 10 years because we bungle our supply targets and prices start to rise much faster than inflation.
Okay, awesome.
Are you the friend or
no, was it that transparent? Yeah. I mean, I picked up a condo that was short-term rental a few years ago. That's absolutely getting crushed, and then closing on another one soon, which obviously the pre-purchase contract.
It'd be interesting to run the numbers to see like you just take the L on the condo and buy something else for the next 5 years,
Yeah, it's hard. Like I'm doing a thing this weekend for first-time home buyers and like trying to because it is like home ownership is still, there's like lots of reasons why it's a really good idea, forced savings, leverage, wealth building. Like if you look at the data, homeowners have, multiple times the wealth by age 65 that renters do. And there's a bunch of reasons for the next few years, like, if you're worried, you're waiting for rates to come down, or you're waiting for prices to come down, then I just don't think that's going to happen. I guess that's a different thing though than like should I be an investor in a condo? It's kind of a different question than should I buy a home versus rent as my principal residence.
Yeah. I think as a first-time home buyer, like in the last couple of years, honestly, it's been better to rent. However, with all the incentives of, first home savings account, GST rebate, property transfer tax exclusion, like there are a ton of stuff that is like, okay, it is pretty advantageous now as a first-time home buyer to get into that market. So, as much as we hate it, they have done some policy changes that kind of force people into that.
But like real estate's also like, especially your home is a long-term investment. Like you're not like, okay, now's a better time to rent. I'm going to sell and rent for 2 years. Then I'm going to buy again. Like, it's just like, that's just not how it works. Right. So
that's my other thing is like, don't try and time the market.
That's crazy to do that.
Ever. Like it's not going to work. It's not going to work out for you.
Yeah. But you're right with the investor thing. It's a different hat, but I agree. If you're going to buy the house, just buy the house if it works for you,
for sure.
Yeah. So I think that's good advice.
Awesome. Well, honestly, we obviously love having you on. Most returning
guests. That went so fast,
and...
I feel like I didn't actually answer a single question, but I'm happy to come back anytime and answer actual questions.
That is what makes a good host. You just feel like you haven't talked about anything. Yeah, we'll appreciate you coming on, and we'll obviously keep track on all your charts on LinkedIn and stuff.
Yeah, thanks a lot, Brendon. It was awesome.
Anytime you need me, just send up the bat signal. I'll show up.
I love it.
I got nothing else going on.
Be careful what you wish for.
Yeah. Okay. Take it easy.
All right. Yeah, thanks a lot.